knows, joining us with her expectations for the data. Veronica Clark, economist at Citi, and on the potential market reaction, Victoria Greene, investment officer of G Squared. It's going to be confusing, isn't it? All right, no, we'll be all right. And a CNBC contributor. Veronica, let me start with you. This is what Tom said, and see if you can confirm it for me. Are there some components of the CPI that are in a deflationary mode more than historically we see? They could give us a cooler number than is expected, and then you add in if used car sales finally, if the fever breaks a little there, could we get a 2.5 read on core?
Yeah, that seems pretty low for year on year for core, but there are definitely some components that we'll see falling in tomorrow's data. Used cars is a big one. Goods prices generally have been coming down. They're a bit softer. We should see some more slowing in shelter, although they're still really strong. So yeah, tomorrow's data could look like some of the weakest that we've seen in a while. We're expecting a 0.3, month-on-month core, but it is on the border between rounding to a 0.3 or 0.2.
The 0.2 would give us an annual of what?
That it's still probably about I think year on year for headline we've got 3.0, and year on year for core I think it's about 4.0. So that's still pretty high. Yeah. Yeah.
So no, you would be flabbergasted if the core was a year 2.5. But what would the markets do, Victoria, if it was that cool? Do you think we get 100 points in the S&P in a week?
Yeah, you could. I think it's a little bit bullish. I mean, he's obviously a pretty bullish guy, but that would be a huge, miss, or not miss on the downside, but a huge surprise on the downside for core. And I don't think services is going to let it get there. So yes, if it is that cool and used car prices have come down enough, it's the goods versus services. And I don't think services have come down enough to let core get to there. But yeah, you get a 2 print and then suddenly everybody's excited. Nobody cares about headline because headline's been a little bit moved around with the base effect and then what's going on with energy. So it really truly is all about core. I just don't think the disinflationary goods is enough to outweigh what's happening in the services sector, especially with housing. So I don't think you get there, but it is nice to think we could get a nice pop if it comes in that cool. Absolutely. Because that would be a huge surprise. And
you have not given really an all clear on the equity markets at this point, Victoria, sort of on the contrary.
Yeah, I think you need to listen to the bond market and listen to the commodity market. The equities markets are rallying as if everything is priced in and nothing is going to go wrong in the second half of the year. And I just don't see the all clear yet because I do look at what the inverted yield curve for a year. They've had an inversion. That's never failed to signal a recession. The commodity market, especially in the metals and oils, have been under pressure. And I just don't see those. You have two signals saying, hey, things might get a little bit worse before it gets better. And then the equity market saying everything's fine. It's all clear. Go ahead and invest. There's no risk in the second half. And I think there's just a little bit more risk. Both the ECB and I think the Fed are going to signal, even if we're reaching the end of hikes, it's higher for longer. Those cuts aren't coming. They're still trying to tighten. And I think that's just a little bit too much to overcome. And all of this good news is priced in now. So the concern is what happens if it's not quite as good on earnings or if CPI isn't quite as good. And I think there's more downside risk than there is on the upside at where we're trading now at 4,500.
Veronica, last week was interesting because people have said that the ADP report usually doesn't have that big an effect on yields, and it did. Maybe it's because of the round numbers for whatever reason, but we went over 4 on the 10-year, we went over 5 on the 2-year, and that's what Tom was talking about. That's when the narrative solidified the higher for longer narrative. That report. Then Friday. I mean, there was some wage gains there, but the number was nowhere near what the ADP number was. It was only 209 or whatever. What was that last week? What did you take away from those two labor market reports?
Yeah, I think people really try to look at that ADP number as like maybe an early signal of what we could expect for NFP. And it's really just not a great indicator for where NFP will come in. It's been consistently undershooting payrolls, the official data. So maybe June was some catch up there. I would say, though, that, 200,000, 299,000, NFP is still a really strong number. We did have the unemployment rate falling again. We had that pickup in wages. And then some of the jolts, the job openings, the quit rate data that we also had last week, I think all still telling us this is still a really tight, strong labor market.
So what do you think, 2 more hikes minimum, Veronica?
Yeah, I think the risks around that are roughly balanced, but we do have 2 more hikes. That's July. I think July hike is close to a done deal at this point. We are penciling in the next one for September. So that's, 2 consecutive hikes. Maybe it's in November, maybe they wait, but I think the data over the summer is still going to look pretty strong, especially, we might get the slowing in CPI inflation, but PCE inflation that the Fed targets can actually stay higher for longer. So we are penciling in July and September, and then definitely upside risk for next year. Also, just that rates could stay higher, for longer than we expect.
What would it take for you, Victoria? When will you think that we're in the clear, where people can just invest for the long term and feel really good, and whether it's 5% lower, 10% lower, a good entry point? What do you think?
Yeah, and I think you need a pullback of at least 5 to 10% because we just got so stretched on valuations, and we got to see the earnings actually pick up. It's in a lower bar still. It's not quite as low as Q1, but I need earnings to actually pick up. I need revisions to pick up and move positive. And I kind of think we need to actually go through this troughing cycle. So I kind of need to see the economy contract and then come back, because I don't think we actually saw the contraction yet. And so I think there's still this more pain to come.